Hello and welcome to the Business Standard Morning Show. My name is Ishan Gera and here are the stories for the day.
This is GE Vernova, helping generate and move the energy that will change the world. Welcome to a new era of energy.
When asked about the logic behind NDTV's takeover, Gautam Adani said that he wants to build a global news brand. Asia's richest man is also planning to roll out a super app soon. He's also raising over $2.5 billion through an FPO to fund his green and digital ambitions. A cursory look at announcements made by Adani in the last 15 days clearly points towards one trend, that he's trying to significantly expand his conglomerate. But why is Adani pursuing such a strategy, especially when large, diversified conglomerates continue to be seen as dinosaurs in the West? Bhaswar Kumar has the answer.
Whenever the media reports on the Tatas, the descriptor salt to software conglomerate comes up. It sums up the wide range of businesses that the Tatas straddle. Recent reports suggest that the Adani Group's ambitions could end up with it having a presence in as wide a range of sectors. In the latest development, the Adani Group on Tuesday won the bid for the Dharavi redevelopment project. The Adani Group reportedly aims to invest more than $150 billion across business segments, ranging from data centers to green energy. The ambitious investment plan is supposed to help the group achieve its dream of joining the elite club of companies that have a valuation of $1 trillion. At present, only the likes of Apple, Saudi Aramco, Microsoft, Alphabet, and Amazon can claim membership to it. After commencing operations in 1988, the group expanded rapidly over the years into ports, airports, roads, power transmission, renewable energy, gas distribution, and FMCG. In recent times, it has also forayed into data centers, petrochemicals, cement, and media. At present, the Adani Group comprises 7 publicly traded companies. From around $16 billion in 2015, the group's market capitalization surged to over $224 billion by November 2022, amounting to an increase of 14 times in 7 years. And the group's ambitions have only grown over the years. According to what Chief Financial Officer Jugeshender Singh revealed about its growth plans, the group plans to invest between $50 to $70 billion in the green hydrogen business and $23 billion in green energy over the next 5 to 10 years. The electricity transmission, transport utility, and road sectors will see $7, $12, and $5 billion in investments. The data center business will involve an investment of over $6 billion, while up to $10 billion are earmarked for airports. The group is also foraying into the petrochemical business with plans to set up a PVC manufacturing facility at an investment of $2 billion. It will also enter the copper sector. Its healthcare sector foray will include insurance, hospitals, and diagnostic and pharma, and will entail an investment of up to $10 billion. Adani also plans to build renewable power plants in Sri Lanka, which is seen as part of India's pushback against China. Now, the Adani Group is ready to unveil its super app, which has been made by an in-house startup. The app, which will take off in the next 3 to 6 months, will connect passengers at the group's network of airports with other services offered by it. While these developments may give the impression that the group is spreading itself too thin, according to Singh, the large conglomerate is the result of a well-thought-out business plan, which calls for foraying into businesses that are adjacent to existing ones. The group's acquisition of 2 cement brands, Ambuja Cements and ACC, from Swiss multinational Holcim may be the best example of this strategy. While this particular foray may have surprised some, the rationale was clear. In the cement business, energy and logistics constitute a major part of the costs. So Adani, whose group has synergies in power, ports, and logistics, was well placed to enter the sector. Meanwhile, in part due to the government's ambitious infrastructure plans, there is a large upside potential for growth in India's per capita consumption of cement. And as a result of the acquisition, Adani has become India's second largest cement manufacturer after Ultratech. But what do experts and industry veterans have to say about Adani's strategy and continued preference for building a large conglomerate?
Mr. Adani, in his public statements, clearly indicates that they are betting on India. And it is very clear that the fastest growing economy for the next few years is likely to be India. And that growth cannot happen without a thrust on infrastructure of all kinds. So he's riding on these two concepts to take the whole path, forward integrated, backward integrated path.
While conglomerates are out of fashion in the rest of the world because they are supposed to be companies and groups that do a lot of things, none of them particularly well, this is not true in India. In India, conglomerates are favored because the data seems to indicate that the most successful Indian businesses are those that have both a public listing so that there's some discipline of the market as well as a connection to a business group, because that brings all the inside information that is needed to succeed in India. The most valuable thing that conglomerates are transferring from one company to another company is their connect with the government, because the hand of the government still plays a large role in Indian business.
That is not to say that the rapid expansion plans don't come with their own share of risks and riders for success. For example, the group had acquired a coal mine at Carmichael Basin in Australia a decade ago, but mining operations were delayed over environmental protests, and coal dispatches commenced only this February.
There certainly is a conglomerate risk, but the connections that he has now been able to make are really synergistic. So take coal. Coal can feed cement. Take cement. Cement will need logistics. Take FMCG. FMCG is critical for rural growth. So if you are looking for scale, profitability, and green, and you don't want to expose yourself to stranded asset risks of a very high quantum, then you need to do two things. You need to bring about a synergistic, fresh investment, and you need to make sure that you can sweat your existing non-green assets very swiftly.
Last week, the board of directors of Adani Enterprises approved a follow-on public offer, or FPO, of $2.5 billion. This will be the country's largest FPO. This would also be the group's second fundraise from the public this year.
The debt is high, no doubt, and will continue to be so. However, with FPO and similar other offerings going ahead, the equity flows will ensure that there is some balance. They are already in the league of those which are too big to fail.
The Adani Group aims to emerge as one of the top 5 corporate players globally. While this is an unexceptionable goal, its success will greatly depend on how the India story plays out in the decade ahead. At the moment, India is a bright spot in a global economy beset by the threat of a recession. But in the long term, the problem of structural unemployment, social unrest, the poor state of education and healthcare, and nutrition deficits among the country's future workforce may weigh heavily on the optimism surrounding India, which may also make Adani's ambitions all the more challenging.
Notwithstanding layoffs in the tech sector, employment by listed companies in India touched an all-time high of 10 million in 2021-22. It was a 9.3% jump from the previous year's numbers. But a look at the rural-urban divide suggests that the pickup is uneven. Participation of women in the workforce also continues to remain low. So what is behind this uneven pickup in job creation? Debargya Sanyal cuts the clutter.
Mahesh Vyas, the managing director and CEO of CMI, writing for Business Standard, has extolled the uptick in employment numbers for listed companies. Employment by listed companies crossed the 10 million mark in 2021-22. Data from Center for Monitoring Indian Economy or CMI reports, as well as the Periodic Labour Force Survey or PLFS, shows that India did well on the employment front between May and September 2022. Urban unemployment rate dropped for the fifth consecutive quarter to 7.2% according to PLFS, while the rate remained below 7% for CMI in the period between May and August 2022. N.R. Bhanumurthy, Vice Chancellor of Dr. B.R. Ambedkar School of Economics, explains the key factors that have led to this uptick.
So I think the job situation in the country is improving. One, because the better growth expectations on Indian economy, a lot of bets on India right now, credit to GDP or credit uptake or the total investments or the foreign investments, all of them seeing an uptick in the economy right now because there is an expectation that it's going to be much better compared to other countries in the world. The second is complete opening up of the contact intensive sectors which have been closed for a long time. And going by the history, that any increase in the formal sector jobs will also lead to increase in the informal sector jobs.
However, even as these numbers paint a positive outlook for growth in employment, there are other data points from the CMI survey that highlight a different trend. According to CMI, rural areas registered a lower unemployment rate of 7.2% for the period between May and August, as compared to 7.8% for urban areas. The labour participation rate or LPR was also higher in rural areas at 40.3% for the same period, as opposed to 37% in urban areas.
That COVID year 2021, the land under cultivation has increased by 40%, right? And labor again increasing by a significant number because we don't have the data, but we know that the hordes of people actually went from the urban areas to the rural areas. And then at the same time, you see as part of the Atmanirbhar Bharat package, how much resources have been transferred to the rural segment and the agriculture sector and the banking sector. So all the three inputs for a production, that is labor, land, and capital, has seen a significant increase during the COVID period. And added to that, MGNREGS allocation, and we have seen doubling of resources going to the rural areas, and the banks also started investing more. So in the overall, I think both in terms of the private sector participation in the agriculture sector and also in terms of the public policy intervention must have really helped in improving the employment opportunities in the rural area very significantly.
A similar divide can be seen when it comes to employment numbers for men and women. The labour participation rate was at 8.4% for women, as compared to 65.7% for men. The numbers were worse for urban women at 6.3% against 63.6% urban males, while the numbers stood at 9.5% among rural women.
The large part of the female is actually working in a sector which are vulnerable to cycles, compared to the male who are especially in the formal sector. So they're part of the cycle as and when there is an economic downturn, it is the female workforce which get affected much more than the male workforce. And I think that we have seen during the COVID and the post-COVID recovery process also, we are seeing that kind of a divergence. When it's part of the cycle, now basically all the time the female labor employment only does the catch up with the growth process. So when there is a recovery process, it takes with a lag, the women employment opportunities will increase.
Dr. Dhanya MB, a fellow at the V.V. Giri National Labour Institute, adds that despite the disparity, the recent picture across national databases is quite optimistic. She said that the labour force participation rate among women has increased from 23 to 24% to 32% according to the latest PLFS. And there is a regular increase in the female labour force participation rate if we take 2017-2018 as a benchmark. The discrepancies within the larger positive picture of India's employment data don't paint a negative picture. Even as India grapples with historic gaps such as the one between women and men's employment, recent policy measures have made a strong contribution in uplifting rural employment figures. However, it is clear that the policy measures should now also focus on allaying urban unemployment concerns. With the 2023 budget round the corner, it will be interesting to watch what solutions the central government proposes.
From high valuations to moderation and growth, analysts say risks are emerging for Indian equities and investors need to be careful in their approach. But are the risks too strong for India? Will our markets be able to tide over this uncertain short-term phase? Watch our next report to know more.
Indian equity markets are on a record-breaking run. For a third consecutive day on Tuesday, the S&P BSE Sensex claimed a fresh lifetime high, topping the 62,800 level intraday. The Nifty 50, meanwhile, topped the 18,650 mark for the first time ever yesterday. From the June 2022 lows, the frontline indices have gained around 18% each, outperforming their global peers by a wide margin. Risks, however, are now emerging for the markets. Nifty 50's valuation has expanded to around 19.7 times, which is 22% above its long-term average. According to Kunal Vora of BNP Paribas Securities India, the bond earnings yield gap has widened to minus 2.4%, which is around 120 basis points, below its average of minus 1.2% since 2009. Historically, at this level of gap, we have seen negative one-year forward returns. Vora says there are limited positive catalysts for any meaningful earnings upgrades, with risk skewed towards the downside. Economically, analysts fear the ripple effects of a potential slowdown in global growth may be felt in India in 2023. Goldman Sachs, for instance, expects growth in the Indian economy to shrink to 5.9% next year from 6.9% in 2022. Waning reopening boost and monetary tightening may cripple the growth in the first half of 2023. But growth engines may pick pace in the second half as global economy recovers, drag from net exports diminishes, and the investment cycle picks up. The third potential threat that investors need to be wary of is a possible change in the capital gains tax structure in the budget in February 2023.
In my viewpoint, I think the holding period might probably increase from 1 year to say 2 years or 3 years. And should that be the case, then in my view, I think nothing goes negative, because longer the holding period, probably I think better in a way that I think people will hold on to equity for investment as well. Currently, most of the, including funds, I think they are trading around equity, I think very significantly. So quite possible, I think that is going to be an outcome, which is a good investment cult as well. Now, whether they are increasing the rate as well, and if the rate increase, I think is brought at par, I think the short-term capital gain times. So be it. I don't see too much of a problem either. But I guess I think they will have to create the differentiation, because if you are increasing the period, then probably the rate will have to be differentiated from short-term capital gain time. Not too much of a worry, because in the past also we have seen that whenever the tax rate has been increased, initially you will cry, but thereafter market has settled down and accepted it.
According to media reports, besides the rationalization of the long-term capital gains tax structure, the government may revise the base year for computing indexation benefits. Manishi Raychaudhuri of BNP Paribas says, investors seem worried about potential tax levies or an increase in LTCG rates in case targeted consumption subsidies to the poorest sections are provided as the general elections of 2024 draw near. Additional tax surcharges or a possible hike in the long-term capital gains tax could dent investment sentiment considerably. On Wednesday, news flow around COVID-19 cases in China, oil prices, and US Fed Chair Jerome Powell's speech will be tracked by the markets. Back home, Q2 GDP data and infrastructure output print will be awaited.
Meanwhile, a threat much bigger than the one being faced by financial markets is uniting the world and dividing it too. Every year, leaders from over 200 nations come under one roof. For over a fortnight, they share ideas and indulge in heated debates to find a solution to one big threat, the rising temperature of our globe. And most discussions boil down to one thing: how much the developed nations will contribute towards the climate fund. But what exactly is this fund? How does it help in fighting climate change? Find answers to these questions in our next segment.
A major outcome of the recently concluded COP27 summit was the agreement on Loss and Damage Fund. The developed countries agreed to offer funds to the developing countries for the loss and damage caused due to climate change. However, the conference received flack for climate advocates for not doing enough to phase out fossil fuels and scale up climate financing. Climate finance refers to local, national, or transnational financing from public, private, and alternative sources that seek to support mitigation and adaptation actions to address climate change. It includes acknowledging the obligations owed by richer nations to their poorer counterparts. The Kyoto Protocol and the Paris Agreement on global warming called for financial assistance from the parties with more financial resources to those that are more vulnerable. Climate finance acknowledges that significant investments are required for reducing emissions and adapting to the changing climate. Let's take the example of one of the most discussed climate financing examples. In 2009, at the COP15 of the UNFCCC in Copenhagen, developed countries committed to a collective goal of mobilizing $100 billion per year by 2020 for climate action in developing countries. The goal was formalized at COP16 in Cancun. At COP21 in Paris, it was reiterated and extended to 2025. At COP27, the Loss and Damage Fund was established, but little was discussed about the earlier commitment. Various financial institutions and technologies work in tandem to contribute to climate finance. This is done majorly to adapt to the shift in global energy infrastructure. The contributions are made by banks, financial markets, derivative markets, stock exchanges, investment vehicles, governments, corporates, and individuals. Governments in some countries have also implemented a carbon tax. It must be paid by the companies and individuals for each ton of greenhouse gas emitted by their businesses. The funds are then used for climate financing. At the COP16 summit in Mexico, the Standing Committee on Finance, or SCF, was established. Its role includes supporting the COP in the mobilization of financial resources for climate financing and supporting the COP in the measurement, reporting, and verification of support provided to developing countries. The committee also organizes an annual forum on climate finance, provides the COP with draft guidance for the operating entities, provides expert input into the conduct of the periodic reviews, overview of climate finance flows, and more.
By the nation's trusted bank, SBI, the banker to every Indian.
During the COP27 summit, India demanded $1 trillion annually from developed countries towards developing and poor countries. That's all for today. For more news and analysis, log on to business-standard.com. We'll be back tomorrow with our next episode. Thank you for watching.
If you liked this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.